On house prices, if the cash rate goes to 3.85%, which is your outlook, that reduces people's borrowing capacity by around 30%. At the worst, you expect house prices to drop by 17%. That doesn't seem to add up.
No, it does add up because remember that's an aggregate, or not all house prices have a home loan against it. So let's not forget that only 36% of Australians have a home loan. Another third of people own their home with no debt. So those house price falls, and that's an average. And so again, it's an input, and it's not a linear relationship with those things. And again, you know, people like you, I don't know when you had your home loan. Just because the house prices are falling in the future or your borrowing capacity has changed, doesn't actually change your ability to repay your home loan today that you may have entered into 5, 10 or 20 years ago.
On unemployment, government this week forecasts 3.75% for mid-next year, 4.5% the following. Your peak, at the worst, you believe that unemployment will hit 3.6% over the next 3 years. Why do you think the economy and the jobs market is going to be so much stronger than what Treasury and what really the market believes?
So again, that was at September 30th, and that was a base case, and we gave that 3.6%. We gave that a 45% probability, which means we've got more weight, 55%, on it being much worse. And in fact, the much worse scenario, we said, well, it could actually be in the sixes. It could even reach 10.8%. If we're right, and there's a mixture of those various outcomes, what's the right amount we need to set aside in our capital ratios to protect customers or protect the bank should things go wrong? And I think, whichever way you look at it, I think we're able to show we've got more than enough. We've got plenty, very healthy provisions balance in that environment. So I don't know that it's not a question of us.
You reduce the amount of money that you've put aside.
No. Well, so wait a minute. When we went into this, we started with 3.7 odd billion in provisions. We released, call it sort of $1 billion of provisions because we didn't need them anymore because they were there for a reason. They were there for COVID. We said, well, we don't need those anymore. And then we replaced them plus some.
You've said that several times that both that employment outlook and the house price outlook was as of September 30. Do you think the situation has deteriorated significantly since then? Do you think those forecasts will change significantly?
If I was a betting person, you said, hey, Shane, as at the close today, do you think it's probably a little bit worse than that? Possibly. I don't know. We'd have to go through and really look at the maths.
What do you think your future loan losses look like with a cash rate rising to 3.85% when currently 10% of your borrowers have less than $100 surplus at the end of each month?
So when we model that, we're pretty confident. So when we assess a customer, that surplus that you're talking about, that is after assuming that when they apply for the rate, when they apply for a home loan, we've already added 3.25% to the rate that we're charging them when we assess it. And so we've added that, we've assumed rates go up 3.25%, and then we want to make sure you've still got money left over.
But that was also done on a lot of your loans over the last 2 years when the cash rate was at 0.1%, when the APRA buffer was lower than what it is now, and when we weren't running at 7% inflation on living costs.
Well, let's look at the facts. So that's not quite correct. So the lowest rate any ANZ customer has ever achieved during COVID in a fixed rate home loan was when they got a 2-year offer at 1.94%. Let's imagine that you were one of those lucky people who got that a couple of years ago. 1.94, we added 3.2% as a buffer. So when we did the assessment to say, can you afford it, we assumed the rate was 5.1. Well, it's not 5.1 even today. So those people come out today. Let's imagine that it matured today and they rolled into a floating rate home loan today. It's less than 5.1. So we've already assumed, we've built that buffer in. By the way, the other thing that we said today,
but most people are going to be, the majority of people are going to be rolling off in the middle of next year when you're saying that the cash rate is going to be 3.85%.
No, but I understand that. But if you hear me out, I'm saying the lowest rate anybody ever got was 1.94. The people who roll next year in the middle didn't get 1.94. They paid higher than that. And so the question is, when we assess them, we assumed rates would go up more than 3% immediately. Oh, and by the way, we assumed that those people never got a pay increase in their life for the next 30 years.
Shane Elliott, thank you very much for your time.
Thank you.